Hello and welcome to Download. I'm your host, Dave Richardson, and we have a very special guest today, who I owe a big apology to because we are blessed on this podcast, and you know this if you listen regularly, and if you don't, subscribe, subscribe where you get your podcast, follow us on YouTube, and give us a 5-star rating, all of that stuff. But if you don't listen to us regularly, you're about to find out why you should. And again, we've just got so many great people to draw from, to bring onto the podcast, to give you updates on what's going on all around the world. And we have so many people to draw from, I forget people at some point. So we haven't had our guest today, Eric Savoie, on for quite some time. I was at a conference last week, and he ended up giving one of the important speeches at the conference, and I went, wow, that guy is so good. Geez, when have I had him on the podcast? Eric, when was the last time you were on? Like last year or
Oh,
January or?
I don't know. Yeah, it's been a while, but happy to be here once again.
Well, it's great to have you. And the presentation was so good that and what we haven't done on the podcast for a while is do just kind of a general overview of what's going on in markets. Just we get Eric Lascelles on to, and he focuses very on the economics, but looking at all different markets, all things around, tariffs, inflation, U.S. dollar, Fed Reserve, stocks, fixed income, just to get a general your point of view on things. I think would be fantastic for investors as we head into the summer. So, and you might have some thoughts around that. So where do you want to start, Eric? It's really a fair game. There's so much to cover.
Sure. I mean, I could talk a bit about what there's so much going on all the time. It seems this year, every week, the narrative shifts quite drastically from a macro perspective. So I think it makes it for quite an exciting year, at least so far, in terms of being someone who's analyzing the ins and outs of what's going on from a policy perspective, particularly from the U.S. With what Trump is doing on the tariff front, and then how financial markets are responding. So we can go in any which direction you'd like, but maybe some quick comments on just some of the key themes that we're
Sure.
seeing so far this year.
Yeah.
Really the big one for us is that the bottom line is that uncertainty is very elevated, right? And most of that uncertainty is coming from the U.S. In terms of their policy on the trade front. And so, as you know, Trump's his approach to negotiation is very volatile, and
Yep.
he flip flops a lot. And so, but I think the big takeaway, at least for us, is that when we look at all the potential headwinds to the economy coming from tariffs, we think the worst case scenario that we might have imagined earlier in the year seems to be off the table.
Yeah.
Even as much as Trump is sort of coming back on with threats in the last couple of weeks, he's shown an ability or a willingness to want to negotiate, to sort of, he comes in hot with a very, very high number in terms of the tariff rate, but then he typically will back off, or even either like lower the rate, or even change his mind entirely. So I think, in the grand scheme of things, uncertainty is still elevated, particularly in the short term. Um, but the economy, at least so far, has held up relatively well. I think that's something we want to acknowledge, just the resilience of the economy, particularly the U.S. economy, but also the global economy. And there's a few other things, positives that we might want to consider, or pay attention to. One is the big beautiful bill in the U.S. That's sort of will have a net stimulative effect on the economy, perhaps impacting or supporting the economy through 2026. And then the other one is just all the big theme around artificial intelligence. I think everyone is aware of this big theme, and maybe not fully understanding the ramifications of the drivers of artificial intelligence. But really, not only will artificial intelligence provide productivity gains for companies, but there's also significant investment that's going on behind the scenes to fuel all of this. So
Yeah.
it's not just the chip manufacturers, but all the infrastructure associated with housing all of those computer chips, and then also powering them. And so there's significant energy demand that's coming from all of this, and all of that over the coming quarters and years will serve to provide some benefit for the economy. So in our view, uncertainty is elevated in the near term. But we think ultimately our base case is no recession, and then perhaps even a little bit better growth next year
Yeah.
as some of these positive themes really take hold.
I think it's really important though, Eric, and I keep saying this to everyone who comes on, and when I'm out with investors, when I'm out with advisors, and I'm out a lot, I'm trying to highlight to them, despite all the uncertainty, all of the noise, all of these scares around tariffs, and I'll give you a really very specific point that I want people to really, I want to highlight so people make sure that they capture this and lock it into their minds. But despite all of this, it has been a very good year for returns. Stock markets around the world have done quite well. Now, a lot of volatility in currency markets, which means you've got to watch what you're actually making in Canadian dollars as a Canadian investor. And fixed income has been, it hasn't been perhaps as good as we might have hoped, given that the Fed started cutting rates last year, as did the Bank of Canada. But overall, despite all the noise, it has been a very good year. And then we've talked a lot on this, Eric, about the emotions and the emotions that sometimes individual investors have when they're investing versus professional investors like yourself and professional analysts, right, whose career is in the business. And it's the idea of the emotions, but Trump seems to even break through that. He breaks through even professionals. I think it was yesterday actually. I'm thinking we're taping this on Thursday afternoon, but yesterday there was a rumor floated through the New York Times that Trump was going to fire Jerome Powell, who's the head of the Federal Reserve. The Federal Reserve is the central bank in the United States. They run monetary policy, so that's currency, that's interest rates, short-term interest rates. Very, very important role. And historically, there's always they've been very careful to keep us all a separation of powers between the central bank, the Federal Reserve, and the presidency, even though it's technically an arm of the executive branch in the US. And so just the floating out of this rumor, the Dow Jones Industrial Average dropped 400 points in a matter of minutes. Now, people panicked and sold just off that rumor. About 10 minutes later, he comes on. He's like, nah, I would never fire the guy. That would be really bad. I don't even know if I'm allowed to fire the guy, which is actually up for debate. And the market just pops right back. So if you react to that in the moment, again, just on the bluster and the rumor and the tweet or whatever it might be, wow, you can get caught in this. So don't get emotional about stuff. Be clinical, be objective, don't overreact. I'm going to guarantee you over the next 3.5 years, there are going to be another 50 times that something like that's going to happen, like yesterday. And you don't want to get caught up in it. So, sorry for my little diatribe there, Eric. But I just I wanted to get that in because I was just watching. I was actually driving into the office, and I'm listening to the business channel, and they're talking about it's like, and so, oh wow, all of a sudden the market's dropping. What's going on? And then it's something in the New York Times, and then and just in a matter of minutes, it's just like a V up and down. So don't get tied up in emotion. Listen to the professionals. Stay objective. And if we want to be objective about this, because a lot of things on both sides around inflation and the impact of the tariffs on inflation. So what's your thinking around where we're sitting with inflation? We had inflation reports out this week, and what did you think of those? And how should we think of where inflation's heading right now?
Yeah, so I mean, and I would echo your point on not overreacting to the day-to-day fluctuations in the news flow because really, yeah, you can really get caught up and make some big mistakes in that. And typically, markets trend higher over the long term. So even during periods of economic weakness or a recession, we know stocks tend to go down a lot. Usually, investors overreact to that, and recessions end up being very good buying opportunities for the long term. And so as an investor, the worst thing you can do is sell into widespread fear, because those are the worst times to do that. And probably what you should be doing is the opposite. Um,
Yeah, look
um,
for opportunity in
yeah,
volatility, which is what
exactly.
Stu Kedwell always talks about when he's on Stu's days with us.
Exactly. On the inflation front, of course, a very tricky situation, given the tariff backdrop. On the one hand, tariffs act as a headwind to the economy, but they should also, on the other hand, potentially cause an upward lift to prices. If you think about it, companies in the U.S. would be subject to higher import costs as they bring in goods from offshore. Um, they will likely be inclined to pass some of that on to the consumer. So ultimately, the consumer will likely face higher prices. Again, there's a lot of questions around this, depending on how high the tariffs or how long the tariffs remain in place. How high is the rate? Will that elevated rate, if it actually passes, will it remain in place for a long period? So there's still a lot of questions. Will companies find ways to sort of circumvent the tariffs or find ways around that? Um, or will they find other operational efficiencies which allow them to sort of absorb that cost? And so there's still a lot of questions around that. But the inflation picture looks pretty good in our view. As you said, some inflation prints have come out this week, looking pretty decent in Canada. We're just right around that 2% objective. In the US, just slightly above it, I'd say very close to it. And you just remember, just a few years ago, we were closer to 7, 8, 9% on the
Yeah,
inflation front. And so there's been a significant improvement on that front. And so we expect the inflation picture to be fairly benign over the next couple of years, pretty close to that 2% level. But we think maybe in the near term, there is a risk that we get some slightly higher upticks to that
yeah,
inflation print just as the tariff effect really comes through. And so we could see maybe closer to 3% at some point over the next several quarters. But ultimately, our view is that at some point in 2026, inflation will settle back toward sort of that 2% level, which will be a good level for central banks to either confirm their current policy or even provide some further accommodation, particularly in the U.S. where rates are still quite elevated.
yeah. So that takes us to the Fed, out of what I was talking about and the announcement yesterday, or the rumor yesterday, and then and then where we come with several more Fed meetings this year. What are your thoughts on the Fed cutting rates? Do you think they're going to continue to sit on hold, or do you think that we might see some relief in the near future, or at least sometime this year?
Yeah, so I mean, I think it's made sense for Powell to be pretty patient in here. Just if you think about what's the Fed's mandate or what is their goal? Their goal is to ensure price stability, and really their main tool for achieving that is setting interest rate policy. But if you think outside of that, there's so much instability or uncertainty coming into the system from a policy or from a U.S. administration perspective. So from Trump and the tariffs and all that. So that it's almost like that uncertainty is sort of clouding or dwarfing the impact of monetary policy in here. And so the Fed, as Powell has iterated in the last several meetings or press conferences, he's iterated that there's just so much uncertainty still. Uh, um, as it relates to the impact of tariffs on inflation, that he would rather just sort of wait it out and to see what will that impact ultimately end up being. He would like to see more clarity, and he can afford to be patient because the economy actually has been quite resilient in the U.S. The unemployment rate is still near historic lows. Job gains are coming in month after month, and so there really is no immediate need for the Fed to cut rates. But we think at some point, as we do get more clarity into the fall, probably the Fed might be in a position where it resumes rate cuts. If you think about it, the Fed is still quite high in terms of its interest rate relative to other countries around the world. We've seen quite a bit of easing in Canada, in Europe, and elsewhere, and then the Fed has been on hold all throughout this year so far. So still at around 4.5% interest rate, and the Fed funds rate versus some of our models would suggest an appropriate rate is closer to 3%. And so we think ultimately they will move in that direction, but probably it will be more clear on the timing later in the fall, maybe November timeframe for the first cut. We don't know for sure. There's still a lot of time between now and then, but we think at some point later this year the Fed will resume its interest rate cuts, and that will probably flow through into 2026, where we expect something like 3 rate cuts over the next 12 months.
Oh, wow. Okay. So Is there any validity to what Trump talks about with respect to, cut interest rates and that'll actually save us money in terms of servicing the debt? Because, the Fed sets short-term interest rates, other rates are set out in the market. So is that a valid point, or is that kind of a red herring that he's throwing out there just to drum up support for, or to, put a little pressure on Powell to lower rates?
Yeah, I mean, I'm probably not the expert on that specific topic. The government's debt is not just all short-term interest rates, and a
Yeah,
lot of it's longer-term debt. And so, whether Powell cuts rates at the shorter end might have some ip- impact in terms of lowering long-term bond yields. I think the main goal, in terms of as it relates to concerns around the debt, is to get long-term yields lower. Of course, the Fed
that's
doesn't
right.
have any say over that, and so. You can see Trump's frustration when he keeps
Yeah.
calling for lower interest rates, and yields actually in the last few weeks, yields have been going up. So I think that's against sort of what the administration is trying to achieve. Although, the administration only has so much power on influencing market pricing, and really the Fed is an independent entity. Um, from from the government. So the Fed will do what it needs to do to ensure price stability based on what it sees and sort of the variables that it's monitoring. Um, yeah,
So maybe a better question that I know is right up your wheelhouse then is so fixed income overall has not been fantastic because it's been a pretty boring fixed income market. It's sort of hold short-term government bonds. The longer end of the yield curve, as you just mentioned, has actually been drifting a little bit higher. So again, given what's just coming out of that, the one big beautiful bill, given some of the concerns around inflation coming out of tariffs, is the fixed income market an attractive place? I know that generally when we've hit bumped up against 4.5% on the 10-year Treasury yield, that's generally been a spot where people take a look, and that it has tended to reverse course and head back down towards 4.25. But where do you see things right now?
Yeah, I mean, in our view, we actually feel pretty good about the fixed income market in here and the rise in yields that we've seen. If we look sort of within our modeling, most of that rise is coming from an increase in real interest rates. It's not so much investors being concerned on inflation, at least that the way that we disaggregate our model. And so there is a growing concern out there in the investing community on elevated debt levels. Sitting at the government level. And so that that is a valid concern. And so investors are basically saying, well, we demand a higher premium for taking on the risk of holding government debt. And so ultimately, from an investor standpoint, actually, that means that investors are going to be receiving a higher compensation for holding
Yeah,
that debt. And so, sure, in the short term, maybe a little bit of volatility coming from that as yields potentially could creep even a little bit higher from here. But over the longer term, we think that serves as an actual benefit for income investors. And our models would suggest that over the medium to longer term, an appropriate level for the US 10-year yield, for example, should be closer to 4%, and maybe even drift a little bit lower as time goes on and some of these concerns dissipate. So, maybe yields can drift a little bit higher toward, above 4.5%, maybe closer to 5%. But really, if you think about it, that's not a big decline in the value of the bond. And when you think of a sort of a 5 to 10 year horizon, that basically boosts your return potential. And so, we feel pretty good about the bond market here, and we think the risk reward for bond investors is pretty minimal at this point because even if yields go a little bit higher, we just don't see a scenario where they go significantly higher, at least not on a sustained basis. We would place very low odds of that happening, and much greater odds of the opposite happening, or even yields just being fairly stable or range bound over the year ahead, which should lead to something like mid-single digit returns for
yeah,
fixed income investors, potentially a little bit more if the economy really were to suffer a downturn. And so we feel pretty good about that, especially within the context of a balanced portfolio.
yeah.
It's a good hedge or an offset against equity market volatility, and provides that diversification.
Yeah, I'm really glad you brought that up because it is so important that you're in a, those kind of returns are actually slightly above average if that's the way it plays out in fixed income. Plus, you get that, and we're going to move to the stock market in a second. But with the volatility in the stock market, all the uncertainty that's out there, bonds play are a nice cushion against that volatility in the stock market. Nice insurance, I guess, would be the more technical way of thinking about it. But bonds and that's always nice. And as you say, higher rates for I'm sure many of the listeners here who are earning income off of their investments. That's not an awful thing either. Although I know us younger folks, we like to we like those lower mortgage rates. So, anyways, that's always the balance. So okay, so let's piece that together. So that's fixed income, that's interest rates, the Federal Reserve. We got the tariffs, inflation. We've covered all that. So let's get to the stock market and what are you thinking about when you're looking at stock markets around the world?
Sure. So, I mean, stock market so far this year, we've seen epic volatility. Um, it's been a wild ride for sure. Earlier in the year, the tariff threats have come in, a lot of uncertainty around that, a lot of fear caused a big panic in the stock market. We saw 20% declines in some of the major indices in March and April. But then since then, we've had a truly massive recovery and extremely quick too. If you didn't look at your portfolio for 3 months or
Yeah,
3 to 4 months, you would have thought, well, nothing really happened despite this massive V-shaped bottom and then recovery. And so now, as you've seen progress on the trade front, I think investors are just more and more catching on to the idea that Trump is unlikely to let the tariff situation really cause sustained weakness in the economy or sustained weakness in the stock market. It's really, if you think about it, Trump probably doesn't want that. And so, as much as his approach is, he seems okay to cause volatility, right? But he doesn't want lasting damage in the economy and the stock market. And so, at every instance where there's been too much pain in the market, he sort of reverses course. And so, we've seen that pattern emerge time and time again, which I think is giving investors greater confidence that which they should probably ignore short-term volatility or perhaps even discount a lot of the threats that are being made. And so, on one hand, perhaps the stock market is right in doing that, but on the other hand, perhaps the stock market is getting a little bit complacent in here as
yeah,
stocks are rising to record levels once again. And so, as you mentioned, the returns so far this year have been quite good, but especially from the bottom in April, like the Nasdaq is up 35% from its April low, the S&P is up over 25% from its April low, and so there's been some really big gains that have occurred. Valuations, which were more appealing 2, 3 months ago, are now getting stretched and getting quite expensive again, particularly in the US. If we look globally, we don't necessarily see valuation concerns. But if we look specifically at the US and particularly at US mega cap technology stocks, so these are the stocks that are driven mostly by the benefits of AI and the theme around that, like those stocks are getting quite expensive in here. So overall, we think the stock market at this point is pricing in a pretty favorable outcome. So there's not much further room for the stock market to really surprise on the upside. Certainly, if things continue to play out in a favorable fashion, if Trump continues to sort of dial back his threats on tariffs, if the economy continues to grow, if inflation, as we talked about, if all of these things sort of move in a direction that are favorable, the stock market can continue to climb for sure. And we should not ignore that possibility. It's one of our if we always run some sort of scenario analysis on what we
yeah,
expect for the market, and that positive scenario is always a potential outcome. But I think we also at this point should consider that there are some other possibilities if some of these threats really materialize in a negative way, or if some other risks sort of surface, the market at this level might be a little bit more vulnerable, at least in the short term. Longer term, of course, as we talked about earlier, the market will go through periods of volatility. There will always be something to scare investors from time to time, and the market will pull back, of course, at some point over the next several months and quarters. But we think long term, there's a lot of reasons to be optimistic as earnings are expected to continue to grow. The consensus, even with the threat of tariffs, the consensus is penciling in 8% earnings growth this year, 14% next year, another
Wow.
14% the year after that. And so of course, these are estimates and subject to wide ranges of uncertainty, but if that continues to play through, if companies continue to adapt and find ways to continue growing, even with the tariff threat looming, long term that should be a pretty positive outcome for stocks. So we think you could still get mid-single digit returns out of U.S. equities. We think even higher than that, maybe high single digit returns out of some of the international markets where valuations are more appealing. So this valuation concern that we see within the equity market is really just a US large cap
Yeah.
story. If you step outside of that into international markets, or even within the US, if you step out of the large cap space and into the mid and smaller cap space, we see
Yeah.
a lot of attractive value in those parts of the market. Um, and so, to the extent that the economy can continue to grow, perhaps you see pretty good returns emerge from some of those markets that just have not participated as much in the last couple of years. So
Yeah.
overall, I would say potentially limited upside in the very near term, just given the
Given the
extent of the
relative. Yeah.
massive rebound that we've seen. It would be difficult for the market to continue to rise in a straight line, and so we might expect a little bit more choppiness in the months and quarters ahead, but ultimately we still feel pretty constructive in the long-term trajectory is likely to be higher.
Yeah, it's pretty clear the market is saying that, a year out from now, because the market looks out around a year, that interest rates will be lower and
Yeah.
earnings will be higher, growth will be good, and those numbers then, that the market's kind of expecting. We need those earnings numbers to come through. And there's lots of reasons to believe that can happen. And one of them, which you touched on in your first comments, is artificial intelligence. Is artificial intelligence? Are we going to start to see that really impact the bottom lines of some of these companies again, where the expectations for their earnings growth are just so enormously high?
Well, so yeah, so that is the expectation. The expectation is certainly quite optimistic.
Yeah.
So the risk is that that expectation is too we've expected too much, right? And even if those companies do deliver very attractive earnings growth, if it doesn't measure up quite to what is priced in, perhaps the market could react negatively to that. But if those promises of better earnings and better margins and better efficiencies and all of that comes to fruition, then certainly the market will react positively to that. And as much as a lot of the AI specific companies are pricing in some benefits to that, really to the point to the extent that this AI benefits all companies, right? Think of,
Yeah.
your companies like Walmart or just grocery stores or companies that you wouldn't necessarily think of as technology companies. To the extent that those companies start to embrace this technology as it becomes more available to them, as it becomes easier to use, perhaps even those companies that we might not even think of start to unlock the benefits of artificial intelligence in ways that we might not have even imagined. So the potential is there. The market's certainly pricing in an optimistic outcome, and so we will see what will happen. It'll all be clear to us in the next few quarters.
Yeah.
Uh, yeah.
As, as long as it doesn't turn into the Terminator, we're good. Should help the bottom line. So with all that, Eric, how do you put it all together into the positioning of your portfolio right now in terms of what makes sense given all of that uncertainty that you've been talking about? Where would you recommend that people have their portfolio relative to their target asset mix?
Right. So when I look at asset mix, I'm thinking in the context of our recommended asset allocation for a balanced investor. This is the asset allocation that we
Yep.
publish from the RBC Investment Strategy Committee. Um, Given the heightened uncertainty that we see, at least in the near term, we think it's important to be well diversified. So that's probably the main takeaway is diversification is really the is critical in an environment where there's heightened uncertainty. And so our asset allocation reflects a couple things. One is a bit of caution on the equity front, just given the heightened valuations and the big move that we've seen, and then also the fact that we feel quite good about the fixed income market. And so we're just sort of juggling those two things within our asset mix. And so our asset mix is fairly close to our neutral allocation. So if you think of 2% cash, 38% fixed income, 60% stocks as a neutral, we're very close to that. We are just slightly overweight stocks at the moment with a
Yep.
61% weighting. So we're 1% overweight. We added to equities in the downturn
Yep.
earlier this year, and we're maintaining that slight overweight exposure at the moment, which we think is the the right amount of risk to be carrying at this point. So we want exposure to that upside, but maybe not too much if things turn out to not come out as good as the market is pricing in. And then the other thing that we've done is within that equity allocation, we've done some shifts regionally. So what we've done is given how expensive the U.S. market is, and we're a little bit concerned about valuations there, we've tilted away. So we've reduced our exposure to U.S. equities within that 61% bucket, and we've tilted in favor of other regions outside the US or more international, so emerging markets, Asia, and in particular European equities, where valuations are much more compelling to us and where we think return potential is more elevated. So that's sort of how we're tying everything together. A bit of a cautious positioning with a slight risk on tilt at the moment.
Yeah.
Um, which I think really, when you think about it, it puts us in a really good position to in the scenario where things play out very favorably and the stocks continue to rise, we will capture that upside to a small degree. But in the other scenario where there's a little bit more volatility,
Yeah.
sitting close to neutral, it gives us the opportunity or the ability to respond to that and maybe make some adjustments to take advantage of the volatility if it were to arise.
Yeah, like the way that the way that you talk about the bond market and where the bond market is sitting, and again, it's always that, what's your potential upside, but then what's your potential downside, which gives you your risk, the downside, and your reward, the upside,
Yes.
and the risk reward in the fixed income market is quite favorable, as you point out. So
Yeah.
so it's so you want to make sure you're capturing some of that, especially if you're a more balanced or conservative investor, but you don't want to miss out on the stock market. So you want to be there, but you can hold a full weight of your fixed income as that counterbalance. You're going to do well in both, but you're going to manage that risk, which is so critical when there's this much uncertainty around inflation, interest rates, tariffs, et cetera, et cetera, et cetera. It just seems like such a sensible positioning right now.
Yep. Exactly.
And that's why you're the sensible guy running that stuff. So Eric, hey, look, we that was fantastic. We can't forget you again. We'll make sure we get you on at least once a quarter. It's always great to catch up with you, and you were just phenomenal at that conference last week. So congratulations on that, because that's a tough spot. You were speaking in front of all of your colleagues and peers and your bosses too.
Yeah. And my
And
boss.
I know that's it. The toughest place to do a presentation is in front of a bunch of people that know almost as much as you know. So
Exactly.
you're always walking on eggshells as you do it. And I just thought you did a fantastic job navigating that challenge. So, anyways, thanks for last week. Thanks for this, and we'll talk to you soon.
Great. Thanks. It was a pleasure.
This recording has been provided by RBC Global Asset Management, Inc. for informational purposes only and is not intended to be investment or financial advice. You should consult your own legal, accounting, tax, investment, or financial planning advisors before engaging in any transactions.